Good morning, traders. This is Chris Buss with Traders Profit Compass with another edition of Before the Bell for Wednesday, April 6th. It is 6:50 a.m. as I'm starting the video. Please run your player at 1.5x. Got a lot to go over today, and I think that'll be a good speed for you. Taking a quick look at futures. Bitcoin down 2%. Oil and nat gas up about 1.5%. Equities down between 3/4 and 1%, gold and silver flat, and really the most important thing today on the macro front is the FOMC notes. Now, what you're looking at here is what I've got written out on the blog site this morning, but I think I want to go over it rather than just sending it, asking you to go to the blog site. I want to do a quick recap for you of kind of where we've been. We talked early in the year about the market regime shift, namely driven by a Fed regime shift, going from supplying massive amounts of liquidity, right? All the stimulus and all that kind of stuff, both monetary and fiscal, to a regime of withdrawing liquidity, letting liquidity drain out of the system. And it doesn't take long to figure out, and you can overlay the market with the Fed balance sheet, and they both go up together. So yesterday, Lael Brainerd, who is going to be the vice chair of the FOMC, known as one of the most dovish Fed governors out there, came out with a pretty hawkish outlook saying, we're going to aggressively tighten, we're going to aggressively run off the balance sheet. And from that point forward, it was a lot of selling in the in the market from about 11 o'clock on after she spoke. Now, we'll get more clarity on that possibly today with the Fed minutes being released at 2 p.m. So, we'll have to be aware of that. I can't imagine anything in there is going to be like a surprise. I mean, they've been saying we're going to do 50 bips. They've been saying we're going to, start QT. Maybe there is news in there, or maybe it will just be viewed as confirmation, and we've already had, that first initial baby sell-off. But the general backdrop, I believe, is going to be choppy waters for equities with headwinds going forward. And that's what we've been anticipating, but then you got to put that into action in terms of your trading and your holdings. And I really think this is going to be, and it really has been so far, the golden age of long-short trading. And the reason I say that, for the last 10 years, it's been the golden age of buy the dip and stay long, because the Fed's right there. Any little blip, the Fed's going to jump in, but now they can't because of inflation. So I don't think, it's not the Powell put, it's the Fed short call. And we've talked about Jerome Powell being up on the high ground with their bazookas, bound and determined to knock financial assets down, because it's the only mechanism they have to slow the economy, is to do a reverse wealth effect. When people see their house go up 30% a year every single year, and their 401ks go up every single year, they're going to be feeling the wealth effect and doing buying and all that other kind of stuff when they see their 401k go down every month, and all of a sudden, home prices start dropping or demand dries up. That's going to affect overall consumer demand. And that's the only way they're going to be able to tackle inflation. So what I've done here is just give you some ideas, and we'll get into specifics going forward about good setups and good sectors. But in general, I don't think the Fed's going to be able to touch commodities. I think they're still in a bull market. I think the companies that are tied into them are going to be in bull markets. The countries that are digging stuff out of the ground and selling them are going to outperform. Brazil, Mexico, Chile, Argentina, what else? Colombia are all countries that if you pull up their charts, they're doing well. Fertilizer, lithium and uranium. I think precious metals and miners will have their day. We haven't seen the metals really do much so far, but I would put them in the camp of looking for longs versus avoid. So I want to make that point. Also, defensive trade downs for consumers that are feeling the pinch. Companies like Walmart and Dollar General and Dollar Tree, where consumers that are feeling the pinch can look for cheaper prices. Grocers, again, defensive sector, but when you have food inflation, they're making margin on higher and higher prices, so they tend to do well in inflationary environments. Same thing for insurance companies, tend to do better in inflationary environments where rates are rising. Defensive pharma, and in general, quality theme and low volatility theme, I think will do well in this environment, at least outperform. Sectors to avoid, we can't say it enough, the Ponzi, bubble, non-profitable names. You can extend that to zombie companies that all in this liquidity injection regime have been able to roll over their debt at lower and lower costs, but now that's reversing. So if you are talented in the respect of digging through the financials or sorts like on FinViz and stuff like that, looking for companies with really, really high debt loads, I don't think those companies are going to do well. And this is, when the liquidity tide rolls out, these are the guys that are swimming naked. They can't finance their debt from ongoing operations. And as those interest rates rise, that makes it even harder for them. And, their debt gets more and more downgraded. Retail and restaurants, if you're feeling the pinch, you're just not going to buy as much. As you're looking through stocks, some stocks are either racing towards their February lows or have already broken them. Whenever you have a fresh low, it means more sellers are going to come in. So I would be looking for those. And I think in general, high beta is going to have trouble in this environment. And some places to kind of figure out the lay of the land. Look at the performance ratio between QQQ and SPY. And when SPY outperforms QQQ, tech-heavy QQQ, it's usually not a good sign for overall market conditions. I'm going to show you a chart on defensive sectors, how they're holding up. When you have defensive sectors lead, again, cautionary tale. One thing that I haven't decided or is going to be hard to tell, but we want to watch closely is mega cap tech. They have some defensive qualities to them, good earnings stream, in most cases reasonable valuations. Let's see if they go after the generals. And if we see the generals begin to wobble and pull back, that's going to be bearish the market. I think semis are an offensive sector to be watched carefully, and I want to watch crypto as well. And I think this last line here is really important. Roughly 65 to 75% of a market's direction is going to be dictated by the general market. So while you may have, let's just take an insurance stock, Allstate, we've been in, it could go down from here, because if the general stock market goes down, even though it may outperform, not go down as much, that doesn't mean it's necessarily going up. So keep that in mind. Relative performance is one thing, but absolute performance is what you get paid on. So just by saying, the market's down 3%, but I'm only down 1.5%, I mean, that's a good start. But if you're still losing money, then that's where the rubber hits the road. So keep these things in mind, and let's watch it close going forward. Let's get into our charts. Nasdaq Oscillator coming down towards the midpoint of the range, but still not to the halfway point. Same thing on NYMO, the New York Oscillator, down at almost the same level. If you look at the new highs versus new lows, notice that on the New York, new highs minus new lows never took out 100, and that's where our escape velocity level is in general. And each time it has gotten close, it's been rejected. Now, if I go and look at the Nasdaq high-low, again, we just had one day where new highs were greater than new lows. And so you can see just visually the regime shift between here, where it paid to buy the dips, here it's sell the rips, never getting above the zero line. So these rallies have been sold, and I think that's the right posture to be in. VIX, we were down in the mid-18s and we popped up above 20 yesterday. I would have your alarm, or at least watching the VIX in relation to 20. If they drive it back down, that'll be a net positive. If we start climbing from here, probably going to see a lot of red on the screen. Here's the defensive groups that I mentioned, and I've showed this chart a number of times in recent weeks. Utilities outperforming SPY. Healthcare outperforming SPY. Staples, we're outperforming consumer discretionary, and that's why we highlighted this in the breakout. You can view this as the recent rally we just had, coming off the lows and rocketing up. But now what I want you to watch, does this thing curl up as staples begin to again outperform consumer discretionary. Here is staples versus SPY, was outperforming. Here's the ramp. Let's see if it doesn't come up and regain the trend line. And this is the ratio that I mentioned on the last slide of looking at SPY versus QQQ. Here you can see since December, SPY has been outperforming the Qs, and we've seen that sogginess in the charts. Qs had its breakout. This is the rip off of the February lows. Now, I want to watch this carefully to see if this doesn't curl back up with SPY beginning to outperform again. Moving forward into the charts, we put in our high the other day, and then we had our selling. I think your pivot this morning is 450. Now, we're trading below that now. I think we're down towards 447. I would not only look today at your support levels, but I would have on a post-it note where these moving averages come in, because they should act as support. And you've got the key over in the corner, or you can do it on your own charting platform. But when you come down to the 50, you'd anticipate either a hesitation or an outright bounce there. If it doesn't, it just shows the intensity of the selling. And then you've got the 200 that comes in down here at 437. I think that's going to be a very important level, because remember, if price is below all the moving averages, there's nothing other than to call that, a bearish setup. So moving on to the 2-hour, you've got a level here at 450. You see the 50 EMA on the daily coming in right here at 444. We've got a ledge at 443, and then we've got a little bit of a void till we come back into these larger volume over price support bars. And here on the 30-minute chart, we've just got a zoom in here where you can identify these levels on the way down. Looking at the Qs, we had the Twitter bounce on Monday. We had the reversal yesterday, and more or less negated this candle, still sitting on this support level, with the 200 coming in at 357.50, and that's kind of where we're at pre-market, right down here in this 357 area. And then note where the 20 and the 50 converge right down here about 354, 355. I think that's going to be an important level to hold, as we come back there. And then, just like we discussed on SPY, if price comes down and loses this level, call it 353, below the 200, below the 20, below the 50, then that's going to give you, that bearish look of having price lower than all the moving averages. And then that would probably open up the door to more selling. Here on the 2-hour, you just get a zoom in showing that 358 area as being important. And then here you've got the 50 EMA on the daily coming in about 355. So those are going to be the levels to watch during the day today. And here, just the zoom in on the QQQ 30-minute. IWM, real wide-ranging bar yesterday. Did a reach up out of the gate to try to reach up and touch 210, then basically gave it up the rest of the day. And then notice here, price is again below all the moving averages. Here's the 200, here's the 8, and here's the 20 and the 50, and we're below that, and we're lower yet this morning. So the next level that I see as being important is down here right at around 200, give or take a little bit. You're going to want that to hold. Here it is on the 2-hour chart. So now we've got two lower highs and two lower lows. So a break of this 203 would open the door down towards 200. I would anticipate somewhat of a bounce there, but if not, down to 198. And notice on this chart, that's your highest volume over price bar there. So I would definitely anticipate a bounce at that level. And while we're talking about bounces, I think it's going to be important for you guys to have a very clear idea of what you're trying to do. For instance, are you playing for the bottom of the box? Revisit these February lows? Or are you going to be trying to game every little bounce that I say, okay, looks like, when and if it happens, looks like 198 is going to hold, or there's going to be a bounce there. Are you going to exit your short and either try to get long for a bounce, or exit your short, wait for the bounce to peter out, then reinitiate your short? Or are you going to say, you know what, I'm playing for the bottom of the box. It can bounce all at once between here and there, and I'm not going to try and game that out. All I'm going to do is methodically move my stops down, or know the point at which I know I'm wrong, and then exit your position. So kind of the strategy and the tactics that you use will have all to do with who you are as a trader and what you're trying to accomplish. But I think IWM is going to be a good tell on the market as well. All domestic companies, that kind of thing, real economy kind of things. And, anyhow, I don't know what I'm exactly trying to articulate, other than to say, when you put your game plan together, make sure it is something that you're comfortable with and can execute really, really well. If you're not comfortable trying to game bounces, don't try and start now. Just be true to who you are, true to what you're good at, and say, I'm going to anchor a position. You might have anchored it yesterday at 210, and that would have been perfect. So you're staying short against 210, and as long as it's below, you're golden. It can bounce as much as it wants. That was a sinister move, by the way. That reach up candle up to 210, that long long-term resistance, and then, gave you a half a minute to realize that it was reversing that touch. So that was pretty interesting. Moving on to Facebook, down 0.8, 0.9. Nice outperformance. I mean, the market was down more than that, and Facebook held up really well. So your pivot today, I think, is 230, and I would be watching. I would be watching these prior lows to see if it develops into something more. But the thing to remember on these downdrafts is don't automatically conclude this is a doomsday scenario. In order for it to hit these lows, it's got to make a new low. So this thing stalls, it rolls over, maybe it comes down here and finds support and bounces or whatever. Or if it doesn't, then you start building that thesis of a series of lower highs and a series of lower lows. And we're not even close to that point yet. We haven't even lost this prior high yet. So it's not an all-in short kind of moment. Apple, levels working really, really well. Came down, was rejected off that 179 high, came down to 175, and it's oscillating there, trading a little bit below that in the pre-market. You've got initial support at 173 down to 172. And you can see here, if you lose 172, I think you're going to move quickly to 170 in this next zone of support, where you see here was support, here was resistance. So we've got a pretty clear band between 170 and 168.50 on Apple. Tesla 60-minute. We had the break above 1100, and then we fell back. So the question now is, was this the bull trap? Fake breakout, then pull back into the range. Be aware of your gap down here, and depending on the action this morning, I think you can be short against 1100. I think that would give you a tight setup, because this shouldn't have happened. It's okay to come up and then do a back test, but it didn't hold. So now we're below. I haven't looked at where it's trading this morning. I would assume a little bit below. And I think Tesla is going to be a market key. I didn't put it down there. I will when I publish the blog this morning. But I think Tesla is going to be a market key. And it's also going to have a huge impact on the ARK flagship fund, ARKK, because it's a big holding within that group. Microsoft, again, rejected at the highs. No real damage done. I would be using 310 as your pivot, and then watching 305 like a hawk, because that was the original breakout level. So you want to have 305 hold if you are a bull. So 310 and then 305. If it breaks above 315, then it was just a scare, and you can be long up to 321 would be my target on a breakout above 315. Amazon found this little head and shoulders buried in the hourly chart. Don't know if it's going to pan out or not, But anyways, here's the neckline. Here's the left shoulder, the head, and then the right shoulder. We've got this 32.33, 200 EMA sandwiched right in here. And I would use that as your trigger. A break below that, then I think this structure would likely be triggered, and it's calling for a 5% drop, which would put us back towards 3,100 or the next level of support, most likely here at 30.80. So I think those are the levels of interest on Amazon. Google looks a lot like Microsoft, rejected at the highs, not even back to the prior low yet here. This morning, I think you can use 2,800 right in there as your pivot, but the real place to watch is 27.80, and what makes that even more important is the void in the charts, that if you lost 27.80, most likely you're going to get a move down here towards 27.10 rather quickly. So, there's another prime example of what do you want to try and do? Are you going to try and do something here right out of the gate on this pivot? Or are you going to try to get short on a break below 27.80 and then play for a quick move down towards 27.10? That's a $70 move. And if things get rolling fast, that might come sooner than you think. Netflix 60-minute had been showing signs of life, but just like the other charts that we've looked at this morning, double top, rejected at exactly the same level, and now back down to this little trend line I've got drawn across. I think you can use 375 as your pivot. If you wanted to just wait and say, I don't want to mess in this area, I want to alarm 370, give this up for more of a not a sure thing, because nothing's ever for sure, but if you took out this low and you took out all of this support, then the path should be more clear down into these levels down here below. And really, if things start rolling downhill to that degree, I mean, Netflix has been relatively weak, and this prior low has not been tested yet, and that's way down there at 330. So even if this thing is carving out a big base, usually what you see is that low retested at some point. Now, it can be sooner or it can be later, but that would be my ultimate target if things start rolling down. And if I had gotten short at 370 and we made it all the way to 330 in the next couple of weeks, I would be certainly taking it off and then waiting to see what happens. Semiconductors, bad day at the office, down over 4%. What I've done here is taken the initial move down and measured it. Here's your bear flag. And then I've extended the measured move towards the target. So this structure points to something down around 248. And given the large volume over price bars here, I would assume that it would just come, I mean, if it got that far, I think it would just come down to 246. And then, we'll decide from there what the next course may be. But this is classic bear flag action. Down, create that bear flag, break the bear flag impulsively, and that's an important component of it, not just have a little baby red bar here and then the next day another little baby red bar. Usually in a bear flag setup, you get that impulsive breakdown out of the flag, and then that sets everything else in motion. We've talked about housing. This is the home construction ETF. We lost this big volume over price bar here at 65. We've got another one coming in at 55 where there may be some support, but then after that we're down in the low 40s. So watch that carefully if you're short home builders. Here's retailers. Down 2% yesterday, but not all that dramatic. We had the initial down move, put in this little rally, had last week bad couple of days, and now a little consolidation. I think if it breaks below 75, I think you're going to come down here to 72 rather quickly, and then there'll be a decision point on whether it's going to go down and at least revalidate these that February low down at 70. So those are all the charts that I have for you this morning. If you're new to the channel, thank you so much. I went through a lot of information quickly to keep this thing at a reasonable hour. Put your plan together. If you like more of this kind of content, please hit the subscribe button and the alarm bell, and then jump over in the show notes to find the link to the blog site where you can drop in your email address, and then you'll get all my content morning, noon, or night. So just to recap, liquidity is draining, going to make it tough on certain sectors, while other sectors hold up relatively better. Decide who you are. Are you going to try and tactically trade every bounce and drop, or are you going to take your longer term cues and longer term view and play for lower levels and not try to game every little bounce? So let's see how Fed minutes turn out today at 2 p.m. See if there's any surprises, see how the market reacts, and then we will take it from there. So thank you so much for spending time this morning. I really appreciate it. This has been Chris Buss with Traders Profit Compass. Talk to you next time.